Welcome back to the Market Pulse podcast from Equifax. I'm your host, Olivia Voltaggio, Senior Content Manager for U.S. Information Solutions. We focus on helping clients navigate economic uncertainty while identifying opportunities for growth in the consumer and commercial credit space. I'm thrilled to be joined today by Shandor Whitcher, an economist at Moody's Analytics, where he helps track and forecast the performance of the U.S. economy across key indicators, from GDP growth and inflation to employment and interest rates. Shandor brings data-driven insight and clear-eyed analysis to complex economic trends, and we're excited to have him break things down for us. Shandor, welcome to the podcast.
Nice to be here.
Let's start with the 30,000-foot view. When you were our guest in February of this year, you had said the economy was in very solid shape. How would you describe the current state of the U.S. economy now?
Yeah, it's pretty notable how quickly things have shifted. So, as you noted in February at the start of the year, we were in great shape, sturdy job growth. We had that kind of not as quick as we wanted, but a steady disinflation going on, and it seems to have shifted quite a bit right now. So, you have all this kind of turbulence in terms of trade policy, and that adds quite a bit of strain. So, tariffs themselves would act as a counter to growth all on their own. But when you have, trade policy shifting weekly, daily, monthly, it really acts as a headwind to decision makers. We'll start with us, right? If it makes it hard for us to produce a forecast, I can only imagine what it's like when you're trying to think about how you're going to invest in a factory or hire a new employee when you don't know what the growth outlook is, a year from now, if not a month from now. And that's, we're really seeing that precipitate a drawback in investment plans by manufacturing firms. We haven't quite seen it yet impact job growth, though it is decelerating. Although it's worth noting some of that's to script, right? The Fed is keeping interest rates higher to help cool the labor market, and that's working. The concern is that now you introduce all this uncertainty, and you might see an even bigger pullback than is really intended.
Absolutely. And on that note, rising jobless claims and a decline in imports have raised the chances for slowing economic growth, and the Fed is warning against stagflation. Can you break this down for us? And what are you seeing in the data?
Yeah, absolutely. So first quarter GDP data were released last month, and we had our first negative print since 2022. Now, a lot of this was driven by an increase in imports, and this was, largely just firms trying to get ahead of those tariffs we were talking about. But this also does point to, a pull forward in demand as firms and businesses try to get ahead of those tariffs, right? So that's, that is a bit of a risk going forward. So, if you're spending something that would have been spent later, now you're not going to spend it later. That's a headwind to growth. In terms of the Fed stagflationary warning, it's just worth taking a step back to note what fair tariffs mean to the economy directly, right? They are by nature stagflationary. They slow growth and they put upward pressure on prices. Now, so far the impact on prices has been muted. This month's CPI will help shed some light on the impact on inflation. So, much of the new tariffs, the prices haven't quite been reflected yet in the CPI data. So we've still been seeing the disinflation we want. Much of that, though, is driven as much by energy as by the kind of the more durable measures of inflation. So, energy prices year over year are falling pretty swiftly as oil production has been increased by OPEC. But the more kind of long-standing kind of structural measures of price growth remain strong, right? So your shelter costs are continuing to grow at above target, and that puts a lot of stress on consumers.
Yes, along those lines, how might this impact the US consumer right now? Are we still seeing strong spending, or are rising debt levels starting to bite?
Yeah, so we are still seeing strong growth in consumer spending. Year over year, real retail spending growth is near 3% in April. And that was an acceleration. Now, as I said earlier, we'll kind of buy some of that strength back by saying, we think some of this is a pull forward in demand. So, while it's always encouraging to get more growth in consumer spending, there's the risk, right, that's kind of borrowing from, your May, your June, your July data. As far as debt levels, I often prefer to look at a household's debt service burden rather than just the level of debt. So this is the share of a household's income they need to spend purely to service debt. And this remains near a historic low. And this, largely because the biggest debt class that most households have on their balance sheet is their homes. And, most households that own homes have locked in historically low mortgage rates. So by that measure, households are still in good shape by and large. Now, one area that is worth paying attention to, just because it kind of gets at some of the segmentation of households, is FHFA mortgages. So we're seeing that class of mortgage delinquency rates trending higher, and that could be a signal that you're seeing some of that stress in your lower and middle income households.
Yes, can you dig into that a little bit for us? What some of that recent credit data tells us, especially among those lower and middle income groups?
Yeah, so this segment of the population's been under quite a bit of stress lately, right? You had surging inflation that was weighing on real incomes, and if you add to that just the surge in lending that happened as the economy reopened out of COVID, you did see delinquency rates just climbing across most asset classes. But many have overshot their 2019 levels. So except for kind of the one key, the 100-pound gorilla in the room, mortgages, right, which still remain low as households, have those mortgage rates locked in and they're in a good position that way. There's just generally a stabilization in delinquency rates. So, while performance is still deteriorating, I would characterize it more as kind of a normalization or a stabilization. So it looks like we're gliding toward equilibrium there. One kind of wild card in this story is what's happening with student loans. So, as these have rolled on, you're seeing the total dollar delinquency rate kind of surge as these are now reflected in the data. So, then the question becomes, will this have crossover implications, right? As households start to feel that pressure and they start to, collection efforts are put in place, right? Do other categories start to feel that pain due to the as student loans are, reflected?
Absolutely. That's a question that we've been covering quite a bit here as well.
Mhm.
Shifting gears a bit, let's talk about small business. What can you tell us?
Yeah, so small business sentiment it's been trending lower since about December, and this really goes back to that uncertainty in the tariffs. So, small businesses are, one, they're anticipating that they're going to face higher input costs, right? So now they're in a pinch, right? We've kind of touched on some of the pressures the consumer has faced. So, can they pass those costs on to the consumer, or are they going to have to eat that themselves, right? That's not a great position for them to be in. And then kind of circling back to that uncertainty story, right? They're not sure if they should, stock up on inventories now. If they do, will there, be ample consumption to eat that? How long are they going to have to hold those? So yeah, overall, the small business is certainly feeling the pressure from all this uncertainty and the rising input costs.
And looking at a broader picture, how are global trends affecting the US outlook?
Yeah, this is an interesting area. I mean, we're seeing uh, a bit of an uncoupling, right? And I guess it's an intentional effect by the administration, but we're seeing a decreased appetite for U.S. assets. So that'll have the net effect of pushing up our interest rates, right? As we don't have this global buyer for U.S. debt, you're seeing that pressure start to show. This could have the effect of reducing the dollar's value, which that'll be a tailwind to trade. But overall, higher interest rates, that's just stands to be a net drag on growth. Another interesting story we're following here is just the decreased appetite for American tourism services, right? So, you're looking at historically low numbers of Canadian tourists coming to America, right? As you just kind of have this, boycott America movements abroad.
Shandor, if you had to name the top two economic indicators to watch for the second half of the year, what would they be and why?
Yeah, so we're actually working on a machine learning recession prediction model right now. Really exciting stuff. And, one of the fun things about kind of doing this kind of work is, it gives you a chance to kind of look at all this economic data we look at in a different and exciting way. So, consistent with that, one of the top indicators that this model uses is the Conference Board's leading economic indicators index. That's just to say this index is doing exactly what it should be doing. But I've always been a believer in that one, but I would continue to tout its merits after the work we've been doing on the machine learning front. And then the other one I would mention is initial claims for unemployment. It's just a really high frequency indicator. It gives you a great snapshot of the labor market. And, if we're going to be tipping, that'll be one of the first places you see it, right? So if, you see a sharp uptick in initial claims, you can anticipate a pullback in consumption. And now you have that kind of reinforcing cycle and a loss of faith in the US economy.
Shandor, so great having you on the show again. How can our listeners connect with you?
Yeah, you can connect with me on LinkedIn. My email's available on Moody's, shandor.whitcher@moodys.com. Ask me any questions you'd like.
If you enjoyed today's episode, please tell your friends about us and subscribe. If you'd like to send us questions or suggested topics for future episodes, email us at marketpulsepodcast@equifax.com. And don't forget to register for our Market Pulse webinar series at equifax.com/marketpulse. Our team of experts works hard to provide relevant economic and credit insights to arm you with the tools to innovate boldly, adapt confidently, and lead decisively. Because when you partner with Equifax, success is always within sight. Thanks for listening, and please join us next time.